Let's continue talking about mutual funds in India in part 2 of this topic. The Association of Mutual Funds in India, popularly known as AMFI, provides data on the different types of mutual fund schemes that we alluded to earlier. For both open and closed-end schemes, the number of such schemes as well as the number of different account holders, also known as folios, are reported in the associated figures that come next, 1 and 2. As you can see, open-ended funds completely dominate the mutual fund landscape. Some of you will recall our earlier discussions regarding India's overwhelming preference for fixed deposits and gold. That preference also manifests itself in the retail investors' choices for debt-oriented mutual funds rather than equity-oriented ones. As you can see from figure 2, while the number of folios in open-ended schemes is 10 times as many as in debt schemes, the average assets under management is 59% higher for debt schemes than for equity schemes. This is visible in figure 3 of our video and applies as of November 2019. In addition to knowing how many funds and how many people are invested in them, it's also useful to get a sense of how investors have trended more into equity mutual funds in recent years. This is available in figure 4. It also gives you a better sense for how debt products were historically favored on by retail investors in India. Inflows into these equity mutual funds have only recently begun to outpace inflows into debt funds, as recent as 2017. Part of these initiatives have really come from the proactive role that the market regulator has played and continues to play in managing, monitoring, and encouraging the growth of the mutual fund industry. Let's look at the policy implications on the equity fund first. As the mutual fund industry began, different types of commissions were paid to individuals who marketed the fund to investors. Those investors were also charged fees called loads when they did not adhere to some of the fund's policies. Loads are like commissions. Likewise, the fees that the portfolio managers, whose responsibility it was to manage those funds, also varied widely. Additionally, the regulator started to look at valuations of illiquid assets that the funds held. Some of the key initiatives that have taken place and have really enabled the growth of this industry are the abolition of an exit load. An exit load is just a fee that mutual funds use to charge an investor when they pull out of an investment. Second, the adoption of a full trail model of commissions rather than commissions up front. Third, the regulator specified upper limits for the costs that the funds could charge investors. This is known as the total expense ratio, TER. India has had amongst the higher in this regime across the planet, but now the regulator requires its daily disclosure. For debt funds, remember we talked about illiquid securities in past contexts, moving to a mark-to-market valuation for securities that don't trade all the time was another important regulatory policy change that India. Allowing investment through digital wallets up to 50,000 rupees per financial year. And lastly, offering tax incentives for investors. Let's look next at some of the policy initiatives that the regulator has undertaken in the debt-oriented mutual fund space. In fiscal year 18-19, due to a liquidity crunch in the non-bank finance sector, many debt funds faced credit defaults on the bonds they held, especially in housing finance. Under the then prevailing regulations, the funds were not nimble enough to recognize and mark down their portfolios on a timely basis. Many funds had to mark their portfolios down 20 and 30% because of credit losses in the housing industry. The following regulations have been mandated by the regulator since then. First, the threshold amortization period for debt securities was reduced to 30 days from 60 days as it used to be before. This is going to move to mark-to-market recognition over the next year. Second, the minimum holding of 25% of assets under management in cash, receivables and government checks was mandated to improve the liquidity of some of these funds in the debt space. Exposure to the housing finance sector was also reduced from 25 to 20% by the regulator in reaction to this housing finance sector crisis. More recently, there has been the creation of side pockets or ring fencing parts of the portfolio that are affected by credit losses. This will help the asset management company overseeing those mutual funds to get some time to negotiate with the issuer of the default securities before they have to mark the entire portfolio down. To sum up, while the growth in assets under management within the mutual fund industry, equity, debt, has been phenomenal, that total assets under management under mutual funds in India is still only 11% of GDP. There is still a long road ahead for the industry. It may be a rocky one, it may be a bumpy one, but as we have told you here and in many other contexts, staying the course for the long run is a key towards wealth creation. Thank you.